Hi guys, welcome to What Stock, where I tell you what stock I'm buying next and why. Today, based on your requests, I've been looking at the cloud market to figure out which is the best company to buy to get exposure to it. I'll do a quick run through of the market opportunity, who the major players are, and finish with who I'm investing in and why. At the end, I'll tell you a great buy price to watch out for. Before we kick things off, make sure you hit that subscribe button and ding that bell so you never miss a What Stock pick. The 2020 health crisis has sped up the digitization of the global economy, with everyone working from home. Companies that didn't have a cloud strategy have now been forced to adopt one. Or die! As a result, the market is expected to see explosive growth in the short term, making cloud a great place to park your cash if you want to get in on some of those crazy returns like we saw with Zoom. Before shooting this video, I looked at 39 cloud and cloud-ish companies to see who the major innovators and beneficiaries of the cloud market are. From that list, I picked the 10 whose technologies I understood and were relatively sticky. If a company buys it today, they won't replace it for the next 5 to 10 years. Sticky. These are the companies I shortlisted as being potential investment opportunities, and these are the reasons why. As you can see, we've got some pure cloud players like Microsoft and Amazon, and some complementary cloud players like Anaplan and Atlassian. In any case, you could probably invest in any of these companies and with a reasonable amount of certainty see your money grow over the next 5 years. But I am the Mad Max of armchair investing, and I only buy one company at a time, so strap yourself in for my What Stock pick of the week. ServiceNow is a cloud computing company based in Santa Clara, California, that helps companies manage digital workflows for enterprise operations. They have 12,000 employees, 6,200 customers, and sell into 80% of the Fortune 500. Companies without automated workflows are dealing with a mess right now, given the fact that many workers were forced to transition into remote roles overnight. ServiceNow offers a suite of IT products aimed at automating workflows like help desk tickets, making it very easy to manage this transition. In the past 5 years, ServiceNow has seen its share price grow on average by 33% a year. In the past 3 years, that's ramped up to a whopping 52% a year. Demand for this stock is seriously ramping up. In the past 5 years, their top line revenue has seen growth of 35% a year, beating Amazon and Workday. In the past 5 years, they've seen their free cash flow, the thing we care most about as investors, grow by a monstrous 40% a year, beating Salesforce and Microsoft. In the past 5 years, they've grown their book value, the thing we care second most about as investors, by 34% a year. In the past 3 years, they've doubled that to 65% a year. But in the past 12 months alone, they've grown their net equity position by over 90%. I very rarely see that as an investor. And it beats cloud poster boys Zoom and Splunk. At face value, these growth numbers are really impressive, really consistent, and really set them apart from the competition. Now let's look at the management numbers. This year now saw a return on invested capital of just over 6%, which is a bit meh. But when you go back over the past 5 years, they have grown this significantly and aggressively, and is a far sight better than the 2016 negative 47% number. Return on equity is a totally different story, but equally impressive. This year they saw a monster ROE of 35%, which is miles away from where it was back in 2016 at negative 117%. Exactly the same with return on assets. A strong number today has been aggressively growing every single year for the past 5 years. The management team is not only growing these numbers, but they keep finding more impressive and more interesting places to take the company. Now that's a management team that I want to invest in. Now let's take a look at the margins. ServiceNow have ginormous margins, and they're getting better. How? This year 78%, last year 76%, the year before 75%. Could this be the first ever pure profit company? I mean, not really, but they're really impressive margins. Operating margins are a slightly different story, but remember what I said earlier about the management team and the fact that they're aggressively growing. That 4% today looks a damn sight better than the negative 36% of 2016. But net margins are the hero of this story at a big, chunky 18%. And that lets me sleep a bit easier at night. As insane as some of these margins are, the take-home message needs to be they are aggressively and consistently growing them. And I can't wait to see what these margins look in 2023. Now, as much as I prefer to watch paint dry, it's not proper due diligence unless you look at the balance sheet. So let's take a quick look at the balance sheet before jumping into the exciting projections. ServiceNow have no debt. Good. ServiceNow have a reasonable amount of cash. Good. We got through that quite quickly. That was 40 minutes of research summarised in 17 words for you. I'm really good to you guys. Thank me in the comments. Now on to projected growth. In the short term, ServiceNow is expected to see some conservative growth, but it's their long-term growth projections that get me really fired up. And 30% compound annual growth each year for the next 5 years is not to be snuffed at. If they continue to innovate their product line, win and retain customers in the Fortune 500, add more resellers to their partner ecosystem, create initiatives with big industry leaders like Deloitte and Accenture, I think it's fair to say that ServiceNow got this. Which leads me to the all-important topic of price. How much should we pay to lock in a good deal? At the recording of this video, ServiceNow is trading with a PE of 137.58 and a PEG of 3.85. The conservative among you may choose to wait for a PE of 80 to 90, which is what ServiceNow was trading at pre-lockdown. But you may be waiting a very long time, considering the market sentiment for this stock is ramping up and the share price is gaining a lot of momentum. The price you pay depends entirely on your investment time horizon. If you have a shorter window of time, you may choose for the price to come down to around $300, $350 to factor in an additional margin of safety. As my investment time horizon is 5 years or longer, I'm very happy to pay these prices because I truly believe in 5 years' time, someone's going to come along and offer to pay a lot more for these stock than I paid for it today. For me, it's a big fat buy and a big fat no-brainer. I like the company, I like the product, I like their go-to market strategy, and I like the fact it's got a very long shelf life. Guys, thanks for taking the time to watch my video. If you have any questions, comments or feedback, make sure to leave them below. Equally, if you have an industry you want me to check out, just let me know. I'm always looking for new investment opportunities. And happy investing.